Hello and welcome to BQ Prime. Joining us today is Mr. Sudhir Singh. He's the CEO of Coforge. He's speaking to us a couple of hours after the company declared its second quarter results, where surprisingly and quite an outlier fashion, the company has maintained its annual growth guidance of 13 to 16%. That when all its larger peers have actually cut its guidance, foreseeing in a way to see a decline in revenue. Uh, Mr. Singh, welcome to BQ Prime.
Thank you, Tushar. It's great to be back.
So, first question, sir. How are you the outlier in this quarter when most of the IT companies have cut their guidance for FY24?
Tushar, this year isn't an exceptional year. For the last 6 years running, every time we start a year, every time we give a guidance, we've either met it or we've exceeded it. We've never degraded it. So this year, to that extent, from our history over the last 6.5 years, is not a change. The one thing that we've always believed at Coforge, and the one thing that we always lead any conversation within Coforge, is execution. It's not as much about strategy. It's not as much only about large deals. It's about the ability to execute on delivery and to make sure that what is signed in earlier quarters is nurtured, is retained, and is grown. There are two things that have set us apart. The first, of course, is an ability to sign large deals despite the depressed macroeconomic environment. This quarter, again, we've signed 3 large deals. And the interesting thing there is the deal that we signed in the banking space is a net new large deal. So it's a new client that we've started a relationship with by signing a $20 million TCV contract straight out the bat. The second thing that set us apart, other than the fact that our large deal velocity is strong and that the large deal median size has been growing up, the second thing that set us apart is our ability to retain the book of business signed in earlier quarters. Just about every industry participant, if you listen to investor calls and commentary, talks about large deals. But those large deals really don't mean too much if what was outside the large deal purview, the existing book of business, is seeing a drip out. Execution continues to be strong, delivery execution. So large deals keep adding to the revenue pool, and I think our team, the Coforge team, does an exceptional job of retaining the non-large deal pre-existing book of business.
So you talked about execution, you talked about nurturing of the deals that you have already won. As I can see in your statement, your order book executable over the next 12 months stands at about 935 million. Correct me if I'm wrong. Your order intake is at $313 million for Q2. So in that sense, are you seeing any delays in decision making? Are you seeing any delays in conversion of revenue, of deals into revenue? I see that your executable book is about $1 billion right now.
You're right, Tushar. The numbers heading towards billion, which is going to be a great landmark for us. Like everybody else, we operate in the same macroeconomic environment. There have been delays in deal signing for now, at least the last 3 quarters. But those delays now, Tushar, have got normalized. So what should have got closed 2 quarters back is now getting closed. Okay. Till about 1 or 2 quarters back, I could have used, if I wanted to, deal signing delays as a reason for revenue not growing. But I can't anymore, even if I wanted to, because deal signing that decelerated, and in some cases has really decelerated 3 quarters back. So that deceleration is now baked in, right? Okay. The time to sign a deal is larger, but after 3 quarters, what should have been signed 3 quarters back, at least in this quarter, should have been signed and has been signed.
So what was the scenario earlier? How long was the lag? Was it, say, if you can quantify it, 90 days, 60 days, and what has it normalized to?
Difficult, and I'm sure you know this, right? The pace of signing a deal depends on factors like whether it's an existing client or a new client, the specific vertical that it is in, the nature of the deal, is it cost consolidation, is it RFP led or not? So difficult to put a hard number there, but I would say that the deals that we signed in quarter 2, out of the 3 deals that we signed, 1 of them we thought we would have signed in quarter 1, and 2 of them we thought we should have signed in quarter 4 of last year.
Okay. Next, coming to your margins, I see that your margin has improved to 11.5 to 58% from 10.36% quarter on quarter. What are, again, have you given out wage hikes? This is one of the margin levers that actually others have used to actually shore up their margins. Uh, so, uh, so have you given wage hikes, and what are the other margin levers in play, and what is your target in terms of margin? So, if you say if your revenue target is 13 to 16%, so what is your margin target in that respect, and what margin levers do you have still in play?
Prashant, our guidance for the year on margins is that we will end the year around the same adjusted EBITDA level as last year, which was 18.3%. Quarter two, our margin went up 160 bips over quarter one. In the investor call earlier today, I said quarter three again, which is a shorter quarter, our adjusted EBITDA will go up around, we believe, at least 100 bips more over quarter two, the enhanced level. We believe this is a RAM that will continue, and we will deliver around the margin guidance that we've given, which is around 18.3% for the full year. There are three margin levers that are in play. The first is hedge gain loss. In quarter two, we net off hedge gain and loss from our revenues. In quarter two, we had a 10 crore Indian rupees hedge loss. Quarter three, if current rates stand, it should be about a 3 crore profit. That's about a 60 bips upside, 60 to 70 bips. In quarter two, we had our annual client event. In quarter three, obviously, it will not repeat because it is by definition annual. So that should give us 30 to 40 bips upside. The third thing which is important is we're running a enterprise-wide average resource cost reduction initiative. We started this around the beginning of quarter one. Results and impact should start getting delivered around quarter three onwards. The last piece that I want to highlight is, unlike a lot of our peers, we did not delay by a single day the increments. Our annual global increments rolled out as they always do on the 1st of April of the current fiscal year. Our annual bonus again was not delayed. Bonus for last year was paid out in the first quarter of this year. So at no stage have we delayed payouts to our employees to manage margins. Those costs are fully baked in. And going forward, all that we're looking at is upsides, which is why the margin guidance is what the margin guidance is.
Okay. You talked about meeting your commitments to your employees as far as payouts are concerned, the wage hikes are concerned. What about hiring? Are you going to hire this year? How is your headcount evolving in this current macroeconomic environment?
Tushar, we're hiring very aggressively. And outside of performance, that's the other thing that sets us apart. From the beginning of the year, our net headcount has gone up 6%. At the beginning of this year, the firm had 23,000 employees. We've added about 1,450. We have not gone back on a single campus offer that we had made. We've honored every lateral offer. We've honored every campus offer. We continue to go to campus. We continue to hire, largely because we are confident of the growth trajectory that we promised. We will deliver on the growth, and equally importantly, we will deliver on every commitment that we made to our employees and to our clients.
Okay. Finally, my last question to you: how do you see? We are at the half-year mark. 2 quarters down, 2 quarters to go. How do you see the rest of the fiscal panning out? And maybe if you can give us some outlook on how you want to enter FY25 as.
So we're crystal clear. The macros are unlikely to improve for the second half of the current fiscal. We are equally clear that irrespective of what happens to the macros, we will deliver on the revenue guidance we've given and the margin guidance we've given. And I want to be crystal clear on both those things. Going into next year, and not just next year, we've always talked about the fact that this wasn't just a $1 billion journey for the leadership or the team. It's going to be a $2 billion and then a $5 billion journey for us. We are doing everything that we can. If you look at our SG&A, even in a year like this, the SG&A continues to go up because we are setting the base with those investments now, new people coming in, new investments being made in platforms like Quasar, which is our new Gen AI based platform, to make sure that next year again, and hopefully the years that follow, will again be a robust growth year. The idea is, shouldn't be a 1 quarter, 2 quarter, 1 year, 2 year growth story. We have now built a 6-year story of sustained CAGR growth of about 18% for 6 years. Going forward, the next 6 years and beyond, we would like to show sustained, robust, and profitable growth.
All right. All right, Mr. Singh. All the best for whatever comes to you in the next 4-5 years. You have a clear pathway that I see. Thank you, viewers, for joining in. This is Tushar for BQ Prime.